Hello friends, good evening to all of you, and this is the session related to BFM, that is Bank Financial Management. And today we are going to cover and we are going to start with a new chapter that's related to the credit risk. So previously we covered the case study based upon the volatility, LCR, HQLS and everything, and now it's time related to the next unit from the module B, which is the most important module in the BFM. So if you're preparing for CAIIB, make sure to WhatsApp me writing CAIIB on the number 83609444207. Now what's the benefit? I'll be sharing a channel link to you where we are sharing the PDF files and everything related to it. And all the PDF files for the CAIIB BFM would be available on our application. Let me just showcase a link to you related to the application where you're getting all the PDF files. It is https://iibf.info https://iibf.info/app. That's a link for the application. So just do download the application from here and use the org code GEGKT, right? So please do confirm the audio video quality at the earliest so that we can proceed with today's session. So we're going to learn about the credit risk. Now, credit risk is the most obvious risk that will be available in case of the banking industry, because banks do act as an intermediary. Banks are not having the funds of their own. Banks do basically mobilize the funds from the depositors, and that fund is being used for the lending purposes, that is used for the investment purposes. So bank is acting as an intermediary. And whenever the bank is lending, definitely there is a risk involved with that the person might not be able to repay the installments, right? And that risk is what? That is a credit risk. So the risk which will be imposed upon the bank due to the default by the borrower, that is said to be what risk? That is said to be the default risk, or we say it to be the credit risk, right? So credit risk is going to arise from which activities? It is going to arise from the lending activities. So when the bank is going to lend the money, definitely the risk can be there. And what risk it would be? It will be the lending risk which will be imposed. Clear with that, right? And secondly, second important thing that we need to understand. So when the bank is basically facing the issues related to the non-payments, it could be related to the fund-based loans, and also it could be related to the non-fund-based facilities. Like when your liabilities do crystallize in case of the non-fund-based facilities, like in the case of the letter of credit, definitely the liability may crystallize. That is also a funding risk, right? And also it may be the case that your counterparty with whom you are basically having a deal or contract, let's say, that is not able to fulfill their obligation, then also a risk is imposed, which will be what? Which will be the credit risk or the default risk, right? So first of all, let's have a look at the organization structure of the credit risk. So we have already read about the organizational structure, about the market risk, and this time we are going to read it about the credit risk, right? So first of all, the overall responsibility lies with whom? The overall responsibility always lies with the board of directors. That always lie with the board of directors. The boards of directors are having the ultimate responsibility related to management of risk. So they do articulate the policies, procedures, aggregate limits, review mechanisms, audit systems, all are articulated by the board of directors, right? And board of directors are going to decide the level of the credit risk. They are going to decide the overall quantum related to credit risk, that how they are going to find out more possible ways to solve it, so as to resolve it, so as to mitigate it, right? So that's about the board of directors. The second tier, it's related to the RMC, that is a risk management committee. Now the risk management committee is what? It's a board level subcommittee. Risk management committee is a board level subcommittee is there, and whatsoever the guidelines which are to be set up, reporting guidelines, or let's say prudential limits, right? Those are being set up by the RMC, and it is the responsibility of the risk management committee so as to ensure that the management process is conforming with the policy. Now, whatsoever the policy is formed by the board of directors, it's the responsibility of the RMC that everyone is following that policy. And whatsoever the prudential limits, those are also set up by the risk management committee. The third tier, it's related to CPC, that is a credit policy committee. Now, credit policy committee is known for one other name, that's the credit control committee. We also say it to be the credit control committee. So the first one, it's related to the board of directors. The second tier, it's related to the board level subcommittee, that is the RMC. And the third one, it's related to the credit policy committee, that is known as the credit control committee, right? So whatsoever the things related to the credit policies, let's say there is some issue with the credit policy or credit procedures, those are being dealt with the credit policy committee. So it's going to analyze the credit risk on the bank as whole, on the complete bank level. It's going to analyze the risk level related to the credit risk. It's going to manage it. It's going to control it also, right? So whatsoever the policies are there related to the credit proposals, related to the terms and conditions for the credit lending, rating standards, or whatsoever the things related to benchmarks, right? Those are being set up by the credit policy committee. So whatsoever the policy is there, that's being set up by the credit policy committee, or simply known as the CPC, right? Last but not the least, it's related to CRMD. CRMD is Credit Risk Management Department. Credit Risk Management Department. And basically it is a independent department. So we can simply be saying that's a Credit Risk Management Department is an independent department. So it's not going to be a dependent department. It's independent of the CAD. Now it's not basically dependent upon CAD, means Credit Administration Department. So there is no let's say interference related to the CAD in case of the CRMD, right? That's the Credit Risk Management Department. So it's going to enforce the risk parameters. So whatsoever the risk parameters are there, everyone needs to comply with those risk parameters, right? And whatsoever the policy is there or prudential limits are there, which are being set by the CPC, that is the Credit Policy Committee, it enforces those particular rules, right? That's the main purpose related to it. And also the loan review mechanism related to the things, and MIS, that is a management information system or reporting things, those are being dealt with with the Credit Risk Management Department. So this is a 4-tier structure, and very important from the exam point of view. Very important from the exam point of view. Let me just tell you once again. First one, it's related to the board of directors. So the overall responsibility is with whom? It is with the board of directors. Board of directors are going to articulate the policies, procedures, reporting standards, auditing systems, everything related to it, right? So that's being set up by the board of directors. Kindly please take a note. Everything is to be articulated by the board of directors, and overall responsibility is with the board of directors. The second one, it is a risk management committee, which is a board level subcommittee. The risk management committee is the board level subcommittee. So reporting to be done by the board to the board level is to be done by the risk management committee. So it's a hierarchy system, we can say. So first of all, the branches will be reporting to whom? That will be reporting to the regional heads, and regional heads will be reporting to whom? Those will be reporting to the RMC, Risk Management Committee, and RMC is further going to convey the data to the board level, right? So that it can be helping it to the board of directors for the decision making purposes, right? And on the second tier, we can say the RMC is going to what? It's going to basically make ensure that the credit risk management process is being conformed with the policy. So whatsoever the policy which was formed by the board of directors, now policy is given by whom? It is given by board of directors, but everyone is conforming that policy, is following that policy or not, that is being ensured by the RMC, right? And also related to risk models which are ever there, which are being used for the quantification purposes. Let's say you want to measure the risk levels. Now quantification is to be done. Now you will be using the different model for the same. Now so as to check the robustness of those systems, that is to be done by the RMC. And also the proper manpower is available for the different processes to be performed, is there or not, that is also to be done by the RMC. Now the third tier, it's related to CPC, that is a credit policy committee. Now whatsoever the loans are to be given, loans are to be sanctioned, now there are terms and conditions related to those loans, right? Those will be set up by the CPC, right? The committee is going to formulate the policies on the standards related to the credit proposal. So if there is in terms and conditions, rating standards, benchmarks, or let's say delegation of the approving powers, prudential limits, those are all being set by whom? Those are all being set by the CPC. CPC is going to set all those things, right? Whether it's related to terms and conditions, whether it's related to delegation powers, whether it's related to prudential powers, whether it's related to asset concentration or standard for the loan collateral, whatsoever the things, or even LRM. Even the LRM, it may be asked in the question that who sets up the LRM limits. It's being set by the CPC. Further, the fourth one, it's related to the CRMD. CRMD, that is Credit Risk Management Department. Now, Credit Risk Management Department is an independent department. It's an independent department. First thing. Second thing, whatsoever the risk management systems are there, risk assessment systems are there, those are also being laid down by the CRMD, right? So we can say the risk assessment systems, those are also laid down by whom? Those are laid down by the CRMD, right? So it also basically does the loan review mechanism, right? So loan review is to be done by whom? It is to be done by the CRMD, right? And it is to be reported individually. It works independently, but it is to be reported to the upper tier, right? And also it's going to enforce and monitor the compliance of the risk parameters. Now whatsoever the limits are being set by the CPC, are we compliant with those limits or not? That is to be ensured by the CRMD. That is to be ensured by the CRMD. Is that clear so far? Now that was the 4-tier structure. Now after that, it's related to the credit risk management framework. Now credit risk management framework is divided into 4 equal parts, or 4 parts we can simply say. One, it's related to, first of all, we need to identify the risk, then we need to quantify the risk, then we need to monitor and control, and the fourth one, it's related to mitigation. The same thing that we follow in other types of risks, that is also to be done in case of the credit risk management framework. The first one, it's the risk identification. So there are different type of risks, and we know the simplest definition of the credit risk. So if the default is there, definitely the risk can be there, and it is having majorly 2 components. One, it is related to the default risk, and the other one is related to the credit spread risk. Now the default risk, I told you what is default risk. Let's say XYZ bank lent money to person A. Now A is defaulting in repaying the amount. That's basically the default risk or the credit risk. And but what about the credit spread risk? That's actually said to be the downgrade risk. Now previously, let's say we lent to the corporate, let's say A, B, C corporate was there, and an amount of, let's say, 5 crore rupees was lent to him, right? Or lent to them. Now what happened, that previous rating was A plus, but now their rating is dropped to B. Right now, in that scenario, definitely a risk is imposed upon the bank, because at the time when the bank has sanctioned a loan, at that time their credit rating was superior, but now their credit rating has downgraded. Definitely it's going to impact, because the risk is involved is increased. Now you know that definitely if there is downgrade in the credit rating, there is much more risk involved in that, and overall there might be a risk that the bank or the the corporate might default. Definitely the risk is there now. So that's related to the credit spread risk, or we simply say to be the downgrade risk, right? So default risk I simply told you, and I gave you the simplest definition related to the downgrade risk. So if the borrower, let's say, is not defaulting, and it's not even the case, it may also be the case that the borrower with the credit rating of AAA might default, but borrower with D category or D rating may not be defaulting. It may also be the case. So we cannot be saying that the lower credit rating basically means that the borrower is going to default at all, right? But there is a huge possibility or probability that is associated with the lower credit rating, that definitely more of the borrowers are going to default from this category rather than from the upper credit rating category, right? So that's the case, and it's basically reflected through the rating downgrade, right? Then further it's related to the portfolio risk. Now, risk which is associated with the credit risk, credit portfolio on whole. Now here we are not going to talk about the single loan or single transaction. We are going to talk about the number of loans. Let's say when we are talking about a category of loan, let's say we are talking about housing loans, or let's say we are talking about the credit card loans, right? So definitely there is a risk associated with it, right? And portfolio risk is going to have two components. One, it's related to the systemic risk or intrinsic risk, and the second one, it's related to the concentration risk. So the one component related to portfolio risk is the systematic risk, or we say it to be intrinsic risk, and the second one, it's related to the concentration risk. Now when we are talking about the systematic risk, now just try to understand. First of all, it may be the case that the loan portfolio is completely diversified. It might be diversified that you have not lent to a single industry but to a combination of the different industries. It might be the case that you have not lent in the single geography but you have sent but you have lent the amount over the multiple geographies or different type of borrowers or different type of markets, so as to basically reduce the concentration risk, right? It might be the case, but still there might be the systematic risk with it, because systematic risk would be related to what? It would be related to the risk which is associated with the economy itself. Now it may be the case that you have you are not having the much more concentration, but it might be the case that there is a huge loss in the economy itself, that economy is not working fine. Now if the your economy is not working well, then definitely your overall portfolio performance is going to be impacted, and that is what, that is a systematic risk. So that will be the systematic risk, or we say it to be the intrinsic risk. It means the risk itself associated with the economy. And the second one, it's related to concentration risk. Now concentration risk is quite simple. When your loan portfolio is not diversified, let's say you have lent money to the gyms only, or to the hospital sectors only, and not to the other sectors. Now if there will be any downfall in that particular sector or segment, definitely that's going to impose a risk upon you. It's going to impose a risk upon you, and that would be what? That will be the concentration risk that will be imposed. All right. And the other type of the credit risk is the counterparty risk. I already told you definition about the counterparty risk. Counterparty risk. Now this is also single loan basically risk which is available, not related to portfolio. Portfolio risk was having two components only. One, it was the systematic risk or intrinsic risk, and the second one, it was a concentration risk. Now again back to the single type of risk, that is a counterparty risk. Now what is counterparty risk? Let's say there is a contract between the bank ABC and the borrower and person B. There are two parties to it, and there is a bilateral contract between these two parties. Now B want to buy 10,000 USDs. It want to buy 10,000 USDs 2 months from now. That's a forward contract B has booked with the bank ABC. Now in that scenario, at the end of the 2 months or on the contract maturity date, the B is going to pay the amount, right? Is going to pay the amount, and ABC is going to deliver the 10,000 USD to the bank, to the person B. That is going to happen. Now let's say the case that on the date of maturity, B said that I'm not having money, I cannot pay the amount. So there is a default from the counterparty side. Now the counterparty was not able to fulfill their obligation, or they basically refused to basically fulfill their obligation. That is what, they have non-performed their obligation. That is what, that is a counterparty risk, right? That is said to be a counterparty risk, and counterparty risk is viewed as what? It is viewed as a transient financial risk. It is viewed as a transient financial risk which is associated with the trading rather than the standard credit risk. So it's not related to the part that you have lent the money to them and there is going to be a repayment loss. If that will be the case, then it will be a default risk. But in case of the counterparty risk, there was a transition or there was some trading to be done, and one of the party was not able to perform their obligation. That's what, that's a counterparty risk. And the last one, it's related to the country risk. It's related to country risk. Now let's say the case, there are two parties in different countries, A in country 1 and B in country 2. Now they want to perform their obligations, right? They are having a bilateral contract, and on the date of maturity, they both want to fulfill their obligations, but the country imposed a restriction. Let's take a recent example of Iran. Let's say case one person is here in India, and the other person is here in Iran. Now the person in Iran also want to fulfill their obligation, but the company has let basically impose some restriction upon it, and he or she is not able to fulfill their obligation. Now the risk which is associated is not due to the non-performance of the individual counterparty, but it's related to the restrictions which are imposed by the country or a sovereign, right? That is a country risk. That is said to be a country risk. Now country risk is somewhat huge. Then we talk about the counterparty risk. Now counterparty risk can be reduced, but it is difficult to reduce the country risk. That can only be reduced if there is a limit set, that on a single country you cannot be going beyond that particular contract limits. So there is a contract limit set upon a country. We also say to be country limit. Now if that limit is set, only then you can be dealing with the country risk. Only then you can be dealing with the country risk, right? Now after that, the second component was what? It was related to the risk measurement. We are talking about the credit risk management framework. So under the credit risk management framework, one, it was related to the risk identification, where we read about the different type of risks, and the second one, it's related to the risk measurement, right? Now the risk measurement could be done through the credit rating or credit scoring, or it could be related to that we are going to estimate the expected loan losses, or we are going to do the expected loan losses estimation, right? First one, it's related to the credit risk rating. It's related to the credit risk rating. Now credit rating is basically related to what? That you are going to check the credit rating of the borrower or of the product, so that you can be looking into the factor that if the person or the borrower is having the capability so as to honor the commitment in the near future or not. That's basically the point related to it. Let's say there is a borrower A and borrower B. Now let's say A is rated AAA, whereas B is rated BB, right? Now let's say AAA is a most higher credit rating and BB is a lower credit rating. Now definitely there would be a point in our mind that if the A person is having the better rating, then definitely A will be going to perform better in the near future, and B may not be performing that much better in the near future. Now which person would be having more risk associated with them? Kindly do answer at the earliest. Do answer. Which person will be having much more risk associated with them? Definitely the person is having better credit rating will be having the lower risk assumptions. So there will be a lower risk assumption related to person A and comparatively higher risk assumption associated with the person B. That will be the scenario. But there is no empirical model for it. You cannot be proving it mathematically. It's just an assumption that you are having, that you are saying that there is a possibility, there is a probability attached with that particular rating, right? And there is a higher probability attached with that particular rating. That's the case, right? And it is also the scenario that even the person with the lower credit rating might not be defaulting, and it may also be the case that the person with the highest credit rating may be defaulting, right? So there is no mathematical model related to it, formula related to it. It's just the point to discuss that more better is the rating, lower is the risk associated. That's it, right? So it just helps us to basically assess that what minimum capital is required. It just helps us to assess that particular thing, that what minimum capital is to be maintained by the bank, right? So there have been issued the necessary instructions by the Reserve Bank of India, like you must be having a better credit rating, and that's being allowed by the Reserve Bank of India, that if the credit rating is given, you can be maintaining the capital associated with the risk associated with the credit rating accordingly. Now let's have a look at the credit risk model. Let's just have a look at the credit risk model. Now there are different credit rating models associated, and the credit rating models are going to do what? They're going to differentiate. They're going to differentiate the different type of borrowers. Now they can be a different degree of the risk or the different degree of the revenue generation associated with the different borrowers, and it's going to, the credit risk model is going to differentiate the borrowers based upon the revenue generation capacity, we can say, right? Because whenever the uncertainty is there, uncertainty that you cannot be generating much more profit from that particular borrow, definitely the capital associated with more. Simple idea that more is the risk associated, more is the capital which would be required. Now just let's have a look at this example so that you can understand it in much better way. So cash generation from an investment in government security is absolutely stable. Now whatsoever the whatsoever the cash that you are going to generate from the government securities, that is going to be stable because there is very low risk associated with it, or let's say even negligent risk would be available. But let's say case when you are going to generate it from the junk bonds, definitely the very lower category credit rating is basically there in case of the junk bonds. Let's say those are unrated. Let's say the junk bonds are unrated, right? Now when something is unrated, it might be the case that higher risk is involved in that scenario, right? Or let's say these are D-rated, that default category, right? And on one side you're having the government securities. Now government securities are very highly rated, so you're having a stable income from them, very low risk we can say. So very low risk is associated over here, but it might be the case that very high risk is associated with it. Very high risk might be associated with the unrated bonds, or maybe in the case of the junk bonds. Clear with that? Definitely it can be the case now, right? So that is the scenario. And further, this would also mean that A rated borrower would have more stable revenue, right? And B rated borrowers will be having the lower stable revenue, and A plus plus rated borrowers will be having the revenue generation will be more stable than the A rated borrowers, right? So that's the case. So if we say B is better than C, C is better than D, and A is better than B, then revenue generation is most stable in case of A, and lesser stable in case of B, and even much more lesser in case of B, C, and D, right? So that's the case. So, and also we can simply be saying that rating has nothing to do with the profitability. Rating has nothing to do with the profitability. It's not about the profitability. It's about the stability. It's about the stability. Now let's have a look at the very important point, that is a rating migration. Now rating migration is very much easy to understand, and you can also be finding a case study based upon the rating migration. Case study related to rating migration, we'll also be covering a case study based upon that, right? Now what is rating migration? Now previously, let's say you were having a portfolio where the AAA category borrowers were 200, double B category borrowers were 192, C category borrowers were 20, D category borrowers were 25, right? And after 1 year when you checked, now AAA borrowers are reduced to 175. Now the double B borrowers are increased to 230, and B borrowers are 0, and D borrowers are the difference of the same whatsoever it would be. Like that can be the case. Now what just happened? There is a downgrade of the AAA borrowers. Downgrade, right? And there is an upgrade seems to be in case of the double B borrowers. Definitely there is an upgrade. Yes or no? Definitely there is an upgrade. Some of the borrowers from C or D would have been upgraded to double B category, right? So that's the scenario. That's a rating migration. And the risk associated with the rating migration, if it's having an adverse impact, then it would be what? Then it would be a downgrade risk. In that scenario, it will be a downgrade risk. Clear with it? Please confirm. Now, let's just look have a example over here. It says a borrower is there, Messrs XYZ, is rated B plus based on its position as on 31st of March 2019, right? And the same company was rated again on 31st March 2020, and further it states that its rating on the same order say became now B. Now previously it was rated what? It was rated B plus, but now it is downgraded to B. So now we can say that the rating of the account is now migrated from B plus to B over the 1 year period. It means there is downgrade in the credit rating, right? Now let's have a look at the table here. Now you can be finding over here that last rating was A, number of accounts were 200, and present rating is what? Now from 200, two are basically upgraded to A plus plus, two are upgraded to A plus, and further 158 are retained under 158 are retained under A, and 20 are downgraded to B, 8 are downgraded to 8 B over here, 6 are downgraded to C category, and 4 persons downgraded to the default category. Default category. Now this migration table is implying what? That if the persons are rated A, then the probability associated or the default probability associated is of 2%. Why 2%? Because 4 persons out of 200 downgraded to D category, default category. So it means 2% probability is there that if the borrowers are rated A, then they can be defaulting. So 2% probability is attached with it, right? And when you'll be having this observation over the number of years, definitely you can be estimating a reasonable default probability. A reasonable default probability can be worked out using that particular data when you'll be having the data over the multiple years. So this is just about that we rated the borrowers. Let's say last rating was on 31st of March 2020, and then you basically rated them on 31st of March 2021 using the same model, and you're having this data with you. Is that clear? Now, what is the major points related to when the rating model will be acceptable? When this rating model will be acceptable, what points are to be looked into it? First of all, the rating model must be, as per the regulators, it must be as per the authorities, it must be as per the rating agencies, and it should be looked into that all the relevant factors have been looked into, those have been taken care into, right? That's the first point. And what those relevant factors are said to be? Those are said to be the risk drivers, so which may basically impose a risk upon your portfolio or on your loan. Those all important factors must be considered. It could be related to the past conduct or history of the account. It could be related to the management. It could be related to industry specific risk parameters. All those points must be looked into, right? Further, whatsoever the credit risk rating is to be done or rating migration is to be developed, that must be developed as per the market furnished or market transparent standards. How the migration is being done, what criteria are looked into, that thing must be justified, right? So those two things are very much important. These are very much important. Now we are going to cover one model, that's the Altman Z-score model. Very important, very important. And even a case study was asked from it last time, right? So Altman Z-score is going to forecast what? It is going to forecast that is your company is going to be bankrupt within the next 12 months period, yes or not, right? That is going to tell that only. If you're going to tell about the Altman Z-score, then it is going to just predict that in the next 12 months, is the company going to bankrupt or not? So there is a criteria related to it and a Z-score that we basically calculate using the Altman Z-score. So this is a Z-score that how we calculate. So you just need to memorize 1.2, 1.4, 3.3, 0.6, 1. First of all, do memorize these decimal values: 1.2, 1.4, 3.3, 0.6, 1. Now we need to understand this A, B, C, D is actually nothing else, but these are the 5 different ratios. These are the 5 different ratios. The first ratio is related to the working capital. The second ratio is related to the retained earnings, right? So I can write over here, the A is related to the working capital, B is related to the retained earnings, C is related to the EBIT, that is earning before interest and tax. The fourth related value is related to market value of equity, or we can simply say MVE. And the fifth value is related to the sales. It is related to the sales. And only the D is related to the liabilities. Only D, in the case of D, the denominator is liabilities, and in all others we are in the denominator as a total assets, whether we are talking about A, B, C or E, the denominator is total assets. Okay, so the first ratio is working capital to the total assets. So do you understand what is working capital? Do let me know, or I'll be making you clear that what is working capital. Let me just give you a simple idea. The amount of the total current assets, not yes, total current assets, that is exceeding over the total current liabilities, right? That is said to be the working capital or net working capital, we say. That is your working capital or net working capital. So the ratio A is related to the working capital divided by the total assets, and ratio B is related to retained earnings. Your retained earnings divided by the total assets, and ratio C is equivalent to what? It is EBIT, earning before interest and taxes. EBIT divided by the total assets, and ratio D, I already told you in that scenario we are having the total liabilities. Total liabilities, not the total assets. It's the total liabilities in the denominator. And further, market value of equity or market capitalization, we can say market cap or market value of equity, one and same thing. That will be the ratio. And the ratio E, that would be related to sales to the total assets, or we can say net sales to the total assets specifically. So these are the 5 ratios, and the weightage associated is 1.2, 1.4, 3.3, 0.6, 1. That's the weightage associated with it. That is the weightage associated with the same. Clear with it? Right? Now, when we'll be solving a question based upon that, you will be getting it easily, how easily we can be calculating the Altman Z-score. Let's just have a look at it. Now here we are provided with the data. We are provided with the EBIT. Now EBIT is associated with what ratio? EBIT is associated with the C. It is associated with C ratio. And for the market value of equity is associated with what? It is associated with D, that is market capitalization. And retained earning is associated with what? It is associated with B. Working capital is associated with what? It is associated with ratio A. And for the sales is associated with what? It is associated with ratio E. And now just let's memorize the formula related to Z-score. How we arrived at calculation of Z-score? Very easy. What was the formula? 1.2, 1.4, 3.3, 0.6 and 1. Clear? Now just do add the plus signs in between. No minus sign, plus signs. Now just write A, B, C, D, E. A, B, C, D, E. And in just case of the D, the denominator is total liabilities, otherwise total assets. In every case, total asset. The A is associated with the working capital. B is associated with the retained earnings. C is associated with that. It is associated with the EBIT. The D is associated with that. It is associated with the market value of equity. And E is associated with sales. So you just now know all the ratios. And you're just easily crammed what formula? Z-score formula. I'm saying it cramming because somehow some formulas are to be crammed. You just cannot be learning them, right? You cannot be learning each and everything, right? You need to cram those things anyhow. Clear with it? Now, let's solve these ratios now. The first ratio, it's the ratio A. So A would be equal to 5 lakh divided by the total assets, that is given to be 20 lakh, right? So it will be equal to 1.2. I'm not writing over here again. 1.2 multiplied by 5 divided by 20. And the B ratio would be equivalent to, it is equal to retained earnings given to be 10 lakh. 10 divided by 20 plus 3.3 and EBIT. It is given to be 5 lakh. 5 by 20 and 0.6. Now in this scenario, total liabilities, which is given to be 10 lakh, right? So denominator is 10 and market value of equity is 30, right? Plus 1 into sales is given to be 50 lakh. So 50 divided by 20, right? So we just need to solve and we will be having our answer. We just need to solve this. So it is 1.2 multiplied by 0.25, that is 0.3. 1.4 divided by 2, that is 0.7. 3.3 multiplied by 0.25, that is 0.825. 0.6 multiplied by 3, that is 1.8, plus 2.5. 2.5. Now we'll be adding them up all. 0.3 plus 0.7 plus 0.825 plus 1.8 plus 2.5. The sum total is 6.125. 6.125. Now how when one can be looking at the factor that we are basically bankrupt or not? So if the Z score is going to vary from 0 to 1.8, then we are going to say that yes, future bankruptcy is there in next 12 months, right? And if it is 1.8 to 2.99, or simply we can say 3, then we say it's a gray area. It's a gray area. Maybe there are chances that you may bankrupt or maybe not. Or if it is greater than 3, then we say no bankruptcy. Then we simply say no bankruptcy, right? So this is related to the Z-score conversion, that how you can be looking into the facts. Clear with it? Now here you are having the different data. So here we got the Z-score to be 6.125, and that's a very good score. So we can simply be saying no bankruptcy. No bankruptcy is there. Have you understood this point? Have you understood the Altman Z-score, that how we calculate it and all? Please do confirm. Right. Okay. So now let's move ahead. We have already solved the question. Here it's for your reference. Now it's related to the JP Morgan's model, that is credit matrix. JP Morgan model. Now JP Morgan credit matrix is also used for the same. Now we used to check what? That we need to check the volatility in the value of the assets. We'll be checking the volatility. In case of the JP Morgan model, we are going to do what? We are going to check the volatility, estimate the volatility in the value of the assets, which is going to be caused by the variations in the quality of assets. So if there is variation in the quality of the assets, definitely the volatility can be there, and more is a volatility, more is a risk associated with it. And volatility is computed by the tracking the probability that the borrower might be migrating from one risk category to the another risk category. It might be a downgrade or it might be upgrade, right? Based upon that, we are going to estimate the volatility. So based upon the migration pattern, we are going to look into the volatility, right? Further, credit risk plus. Now credit risk plus is a credit rating model, which is basically developed by the Credit Suisse. Credit Suisse has basically developed the credit risk plus, and it's a statistical model. We do use the statistical techniques so as to evaluate, right? And the calculation is based upon the expected default rates or unexpected losses due to default, right? So if there are expected default rates which are expected and unexpected losses which are going to be there from the default, based upon that, we basically look into the credit rating model. That is a credit risk plus. Further, it's related to credit risk control and monitoring. Now, definitely now we have done what? We have identified the risk. We have quantified the risk. Now it's related to credit risk control and monitoring, right? First of all, lending is a very widespread activity in the bank. It is actively being done. So there is a very high share of the credit risk among the other different risks in the bank, right? So when the bank is there, you simply thought of what? You don't think of it, okay, that it will be investing in the money into the different things. You'll be thinking like it is taking money from us and it is lending to the others, and that's a huge space which is being covered, right? So if we are saying 90% of the activity, we can say, is related to the lending only, right? In a general way, we can say. So we can say there is a very high share of the credit risk involved in the total risk taking of the activity, right? So active portfolio management is to be done first of all. So if you want to keep up with the economy, dynamics of the economy, active portfolio management is to be done. What do you mean by active portfolio management? So let's say case we are having a portfolio here, right? Now in this portfolio, the diversification should be there. The diversification should be there related to the geographies, related to the different type of the loans or something like that. So the diversification is to be done first of all, right? And also you are to look for the credit risk mitigants which are available. You have to look into different techniques which are available, like derivative. You can be using the derivatives, you can be using the different type of guarantees or everything, right? That is also available. So active portfolio management covers each and everything, right? And it is a very basic prerequisite, very basic prerequisite related to effective control and monitoring. Okay. Now, after that, it's related to credit risk policies and guidelines at the transaction level. Transaction level means what? When we are going to sanction a single loan, then in that scenario, what things are to be looked into? So better proposal is to be done. A risk analysis process must be very much robust, right? And for the credit audit and loan review and monitoring process, all these things are to be taken care of. And these are the instruments. These are the 4 instruments related to the credit risk management at the transaction level. Transaction level means when we are going to sanction a single loan. In that scenario, how we can be dealing with the credit risk? That is the credit risk management at the transaction level. So first one, it's the credit appraisal process. The second one, it would be related to the risk analysis process. The third one, it is a credit audit and review. And fourth one, it's related to the monitoring process. All those 4 are the instruments, right? And the first one, it's what? It's related to credit appraisal process, like systematic evaluation of the borrower's credit worthiness is to be done. So when a borrower comes to you, you do check the CIC reports, credit information reports, right? And you do check the analysis, like you'll be checking their financial statements, whatsoever the cash flows or their repaying capacity, what is the purpose of advance, what quantum of loan can be given, what is the repaying capacity, what is the tenure of the loan, pricing of the loan, everything is to be checked, right? That is what, that is a credit appraisal process. And second one, it's related to credit risk analysis process. Like we should be identifying that what type of risks may be there. What is the probability of default by the borrower? What is the industry risk or sector-wise risk, business risk, whatsoever there, or financial risk? So what type of risks are there? That's the risk analysis process. And the third one, it's the credit audit and loan review. Credit audit and loan review. Now, credit audit and loan review is just related to what? That we are going to examine the objective of the decision, our credit decision, after the sanction, right? Now, the scope is related to what? That pre-sanction and post-sanction audit, it is to be done, right? Credit audit means what? That pre-sanction things which were there, were those done properly or not? And post-sanction things which were done, what those were done properly or not, that is to be done. And further, for whatsoever the purpose the loan was sanctioned, is the intended use is now being checked or looked into or not? Let's say we have sanctioned a loan for purchasing a car. Does the borrower have purchased the car or not, right? Those all things are to be looked into, right? And also we need to assess the documentation, right? That proper documentation is done, proper charge creation has been done. All those things are covered under the credit audit and loan review. And the fourth one, it's related to the monitoring process. That's a continuous process, that we are going to track the borrower performance, that particular installment is being paid, particular asset is being maintained, collateral is maintained, and use of funds, right? And also in case of the term loans, wherever required, like we are going to check the drawing power limit is set properly, is a DSCR maintained properly, debt service coverage ratio is maintained properly, everything is to be done, right? And also it helps us to basically identify the early warning indicators, early warning signals, right? So those are the 4 parameters for the credit risk management at the individual level. Is that clear? Right? And that is to be done why? Because we want to constantly improve the efficiency. We want to improve the efficiency for each of the processes. That is the main thing, right? Credit quality of the borrowers, we want to basically improve. We want to enhance the default analysis. We want to capture the risk elements, right? We want to provide for the early warning signals, and all our objectives are fulfilled if we are going to follow these four particular things. Okay. Then after that, the credit risk taking policy and guidelines at transaction level should be clearly articulated by the bank in the bank's loan policy document approved by the board. So that is to be approved by the board, and policy will be given by whom? By whom? That will be given by the credit process committee, right? That is to be given by the CPC. Then further, its related to standards and guidelines should be outlined for that who can be sanctioning what amount, credit appraisal can be done how, what would be the rating standards, what will be the benchmark standards, what is the pricing strategy, how the pricing is being done, how the LRM is being done, right? Standards must be set for all these particular guidelines. All these things must be looked into. While we are basically looking for the standards now, all these things should be covered. First one, it says related to the delegation of powers. Delegation of powers. The bank must be having a policy related to delegation of powers. Definitely it's a multi-tiered system in the bank. There is scale 1, scale 2, scale 3, scale 4, AGM, GM, right? Multiple cadres are there, right? And what power will be given to what person, what authority is given, what power is delegated, right? That must be looked into. And there should be a multi-tier credit rating approval system or credit approving system itself, which there will be a committee at the regional office level or the zonal office level or even the head office level, who will be looking into the different proposals which will be sent by the branch heads to the regional offices or to the zonal offices or even to the head offices. And the committee will be comprising of 3 or 4 different officers who are going to approve the facility over and above a specified limit, right? And that's the case. And one officer of this committee is going to represent the CRMD, credit risk management department, right? That's the first case. And the second one is related to credit appraisal. Credit appraisal. Now the credit appraisal guidelines include borrower standards. What the standards will be maintained? What are the procedures that we can be looking into credit requirements or risk factors? What are the procedures related to those? What are the policies on standards for presentation of the credit proposals? Financial covenants, what should be there? So credit appraisal covers each and everything. It covers each and everything related to that, how it should be appraised, what are the covenants, what are the terms and conditions, right? Every single point will be looked into. Clear with it? So in case of the delegation, we are going to look for the structured allocation of the sanctioning powers. In case of the credit appraisal, we are going to look for the borrower analysis, financial appraisal, technical appraisal, managerial appraisal, viability of the particular project, assessment of the security. So credit appraisal to be done that way. And the third one, it's related to the rating standards. First of all, it was related to rating standards or the benchmarks. That is basically covering what related to the quantification of the credit risk, or let's say internal risk rating models are there. Like if we are incorporating any internal rating model, and also let's say if we are having the benchmarks, then benchmarks related to the loss given default, related to the probability of default, those must be looked into. Rating migration analysis, how it will be done, right? Minimum acceptable rating is which one? So all these things will be covered under the rating standards and the benchmarks. And if you look at the prudential limits are related to what amount of loan is to be sanctioned. We can simply be saying that we want to basically limit the risk. Now, let's say the exposure norms are also to be looked into while we are sanctioning a facility. Exposure norms. Now, let's say if the bank's exposure norm says, as per the Reserve Bank of India guidelines, that the individual exposure is to be limited to 25% of the tier 1 capital as available on the last day of the last year, then we cannot be sanctioning much more amount than 25% to a single individual. That's a limit which is imposed. So it may be the related to large exposures. It could be related to the asset concentration. If you want to basically limit the concentration in one particular industry or one particular geography, then it may be the case that a limit is imposed, right? So those are all the prudential limits, and prudential limits basically limit the credit risk, because they do limit us in a way that no more advance can be sanctioned above this limit, right? So it could be related to the profitability ratio, it could be related to the financial ratio, right? So those all limits are to be looked into. Like if you're even going to, let's say, DER, right? Or it could be based upon the return on the assets. No, we cannot be lending beyond that particular limit if it is not allowed as per the policy, as per the credit sanctioning process or credit appraisal. We cannot be sanctioning. So those are the prudential limits. Those are the prudential limits. Then about the rating and standards, I've already told you, right? That whatsoever the models we are using, whatsoever the migrating patterns or migration, how we are treating it, what is the minimum standards or benchmark rating is required, we'll be looking into all those things. Further, it's a risk pricing. No, definitely risk pricing is very much important, because we are to price those loans more which are more riskier. So that is the concept is RAROC, risk adjusted return on capital employed. Now, if you're basically lending to a credit card person, definitely you have to charge more. So definitely if risk is more, you have to charge much more interest rate upon it. That thing is to be done, right? And further, that the credit spread is also to be taken care of. Credit spread is also to be taken care of, right? So credit spread should have a bearing on the expected loss rates or charges on capital. Like if the migration is done, migration is there, now we know that there is a probability associated with the A-rated borrowers over the 5 years tenor, that the 5% are shifting toward C category. Now we already know that there is a probability that 5% out of the 100 loans are to be downgraded from A category to the C rated category. No, we will be charging the pricing accordingly already, right? Those all things are to be taken care of. That is also to be taken care of. So risk pricing, when we are talking about, we should be looking for the internal credit rating risk grade. We should be looking for the cost of the funds or the operating cost or the expected credit losses or the tenors over there, because longer is a tenor, more is a premium that you should be charging over it, because your funds are to be used for the longer duration than intended, right? Those all things are to be covered in it. So pricing strategy for credit products should be moved toward the risk based, like based upon the RAROC, and credit spread should be taking a bearing if there is an expected loss rate. And for the borrowers with weak financial position must basically have the high credit risk, definitely, and those loans should be priced more, definitely, we know that, right? And for the it is bearing on the probability of default. So if the probability of default is more, definitely much more pricing is to be done, right? And also the value of collateral, value of accounts, future business potentials, they also play very important role for the pricing purposes, right? That's the case. So any attempt at the price cutting for market share would result in the wrong pricing of the risk. It means what? Let's say a bank is charging 7% on the home loan, and your bank position or bank profile is not allowing you to basically charge lesser than 8.5%, but looking at the competition, you lower the interest rate to 7%. Definitely that will be a faulty pricing. That will be a faulty pricing. Okay. Now the next one, it's related to credit control and monitoring at the portfolio level, but that will we be covering in the next video, not today. So if you have understood the concept so far, make sure to download the PDF. Simply just WhatsApp CAIIB to 83609 and you can also be downloading our application where you'll be getting the complete CAIIB course. The CAIIB early bird pack is available, which is very much efficient, and you'll be getting all the 5 courses in bilingual language. And if you want to get the English only pack, the 4 compulsory papers will be covered, and that pack is available. Just do enroll right now. Download the application from the link https://iibf.info/app, and just download the application and start preparing for the same. And if you're iOS user, it will be requiring to add the org code, which is GEGKT. And if you have liked the video, make sure to hit the like button and also press the subscribe button along with the bell notification icon so that you get updated whenever we upload the new videos. So that will be all. Thank you so much and see you again in the next video. Happy learning.